Check 1, 2.
Go! Curious about real estate? Yes! Then you've come to the right place. Get the knowledge you need. Get over the fear and get started. This is the Michael Quarles Real Estate Show with your host, Michael Quarles.
Hello, everybody. Michael Quarles with Podcast 58. Man, this is an exciting podcast. Today we are not going to do the 5 investor questions because I'm bringing you guys something really special and incredible. It is friggin' awesome. Yesterday, Gabriel Contreras negotiated a transaction with a seller that was so unbelievably over the top, I had to bring him on the podcast today and explain it. It took him like 45 minutes to explain it to me, and I almost fell down. I could not believe he was qualified not only to ask the questions, but got the results that he was hoping for. It's fantastic. Gabriel, welcome to the show.
Thank you. Thank you for having me, Michael.
Hey, tell me about this deal. The one that I just couldn't believe you could do. The one that I certainly wouldn't have thought could be done. Tell me about this deal from the very first time you said hello to this seller. Now, folks, I saw the contract, so I know it's real. To all the way up to getting the contract. Tell me about how you negotiated it, how you worked on price, what they originally wanted, what you guys settled on, what you expect, and how you're going to get your return dollar back to you. So let's start. Tell me about this deal.
Okay. Well, like any other deal, it all starts off with what the house is worth, and you have to figure in what it is that you want to accomplish, where it is that you can actually buy it at. So once you figure out those numbers, it's just a matter of working the numbers and making it to where it's an acceptable offer to the seller. Now, in this case, one of the challenging parts, or the challenging part, is the fact that the seller owed more than what we are willing to pay for it. He still owes less than what it's worth, so it makes it, an attractive conversation, if you would.
Let me jump in real quick, just to make sure everybody understood
Sure.
what Gabriel just said. The seller owed more than what we were willing to pay for the house, yet what he owed was still less than the value of the house. Okay, so continue, please.
Sure. So we figured the house to be worth somewhere in the neighborhood of $45,000, and we're very conservative as far as where we think the house is worth, because of course we're buying all these houses without ever even going out to look at them. So the market will always dictate what the value of the house is, regardless of some of the opinions of what the seller says. Once we establish what we believe the house to be worth, then we can work backwards and figure out what we're willing to pay. The seller actually owed $40,000, or very short of that, okay? And we had figured that if we were to buy it on a cash process, on a cash transaction, we'd probably end up somewhere around $25,000, maybe maybe $30,000, somewhere in there, $25,000 to $30,000 on a $45,000 house, depending on repairs. So we do have to go through the process of finding out, hey, is there repairs on this or not? We've discovered through the conversation that there wasn't much repairs according to the seller, and we have to go with that until we send out our local professionals to construct our offer. It wouldn't be more than $500 to $1,000 worth of little things, one broken window and whatnot, that the seller states the house needs. So repairs not a big consideration in it. Again, the biggest challenge is the fact that he owed a lot of money on it. He actually owed pretty close to $40,000. When we buy cash, we have to be very aggressive, but then we can also talk about the time value of money of our investment dollar. So if I don't have to invest my personal capital, or the other way to look at it is if I don't have to go out and borrow that money to pay for the house, whether it's my money or borrowed money, you still always have to calculate what it costs to get that money. So there is a cost in that. And so if we don't have any cost, that allows us to be able to pay more for it because we don't have that time value of that money cost. So we knew, or I knew that we couldn't pay what he owed on it. So it's pretty simple, really. If he owed less on it, then we have something to talk about. So it's as easy as that, Michael. It's as easy as letting him know you owe more than what we're willing to pay for it. So in order for us to buy your house, you need to owe less. So, it really is that simple.
So at this stage, I mean, even prior to this stage, now I know everybody's listening, and there's a lot of us that are listening, and those of us who at this stage would not have even had a conversation with the seller, let's raise our hand, because I'm raising my hand. The seller owes more than I'm willing to pay for it. I'm done. I'm saying thank you for calling me. You have a great day. I'm going on to the next call. But Gabriel, you didn't raise your hand. Are you friggin' kidding me? You did not raise your hand. You're continuing to talk to a seller that owed more on his house than what we were willing to pay for it. How did you get him to reduce that?
It's called asking questions, Michael. That's all I really did. I figured that, okay, if I can pay $25,000 to $30,000 for this house, then all I need him to do is owe $25,000 to $30,000 for his house. And so I simply asked him, would you be able to take what you owe and bring it down to $30,000? He said, absolutely not. I won't do that. The most I will bring it down to is $35,000. And that's it. It's as simple as that. I just basically said, bring that balance down.
So he willfully said, I'm not going to bring it down to 30, but I'd bring it down to 35.
That's correct.
Did you ask him if he had been drinking?
No, that's not part of my script, Michael.
Because I would think that he'd have to be drinking or something, because that seems crazy to me that someone's willing to... Now, it's not so crazy if he owed more than the house is worth, but he owes less than the house is worth. You want him to take money out of his pocket, basically pay to sell his house, to get it to a point that causes you to say, okay, I'll give you, in this case now, I guess he's at 35. Did you stay at 35 or did you get it lower than that?
We actually went through the process of, is that the least you will take? Will you do any less? And so on, as we do with every single transaction. And, to be honest with you, Michael, this scenario happens quite often. The more times you ask it, the more times you're bound to find those that say yes. Okay? So, and the other thing that happens is when you're out there buying and selling houses, and, in the past we were exposed to doing it for other people, representing them and doing so. I'm talking about being a realtor some time ago. We got to experience on other people's transactions that there's many, many times, it's actually very common that sellers will sell their house and at the end of the day, they have to come in with a check. So it really is not that uncommon. It's actually very common, depending on what market you're in. There's many times where sellers owe an amount of money where after paying for all the costs, they have to come in with a check in order to sell their house. So this isn't really any different than that. Does that make sense?
So what you're telling me, but because of your experience and the fact that you've seen it done before and you weren't afraid of the question and you certainly weren't afraid of the answer, you just went right ahead, opened that can of worms, opened that door, and asked the seller, will you bring cash to the table to close?
Absolutely. It's really simple. How much will you be willing to pay in order to go ahead and sell your house?
At a reduced value over... That's guys and gals that are listening, that's what's incredible to me about this. He's selling his house less than it's worth, and he's still feeding it. What a great negotiator you are, Gabriel. So there's more to this that just makes this friggin' exciting. Tell me about the other stuff.
Okay. Well, once we've covered that, the fact that, here's the thing, though. We really have to be conscious of the fact that we figure out what it's worth, and we figure out what we will be willing to pay for it. Once we figure out what it is that we can actually pay for the house, the rest of the numbers just need to be set aside and forgotten, because it really doesn't matter anymore what it's worth, other than to calculate, is it a good transaction for you or not. Once you figure out this is what I can pay for it, and that's all you can really focus on. We focus on what we can pay, and as I recall, my number said I can pay maybe $25,000 to $30,000. He went ahead and agreed to bring the balance down, which means he's going to have to make a check to bring the balance down to $35,000. Well, that number is still higher than what my cash offer is. So at this point, I need to now incorporate other ways of making it make sense financially. And this is where that topic of time value of money comes in, okay? Because I'm always going to calculate, even though we can go to the bank and cut a check from our own bank account, it doesn't matter. We still have to figure out there's a cost for that money. If I were to go out and borrow that money from a hard money lender, I'm going to pay 6, 8, 10%, whatever it is, and that needs to be calculated. So if I can take 25 or 30,000 of my own money, or I can take somebody else's money and eliminate the cost of that money, then that's where it makes financial sense. So that will be my next step, and that is to say, okay, so I want you to become my lender. Now that you brought down the balance.
Wait. You had him agree to bring money to the table, and now you want him to let you borrow money?
That is correct. That's the only way that's going to make financial sense, Michael. Is I now need to be able to invest more money than I was willing to pay my money, and that choice is for him to be the one that lends me the money. So I'm asking him now, okay, now that $35,000 that we've brought it down to, I need you to be the one that lends it to me. But not only do you need to lend it to me, you need to lend it to me at a rate, at a cost that's lower than what I'm going to be able to go get it elsewhere in order for it to make sense. Is that coming through okay? Does that make sense now?
I'm still sitting in my chair, shaking my head side to side. Just can't believe what you did, but I'm glad you did it. So tell us what did he end up doing?
Okay. He ended up asking, well, how can we do that? I presented a couple of different choices. One of the ways that we can buy houses is by not borrowing money and simply taking over the money that is already borrowed, meaning taking over the existing mortgage or existing loan on the property, and then just continuing making payments on that. That's very common in our industry. It's simply referred to as subject to the existing financing. All it means is the loan will remain in the house, the loan will remain on the seller's name, and all we do is make the monthly payment on it. Of course, our overall goal is we invest none of our money, which makes it worthwhile, as we've already explained. Now, he had a concern about that. He is very credit conscious. He spoke about it a lot. I've worked for decades. I think you mentioned somewhere around 20, 30, 40 years it's taken me to build my credit, so that's very important. I'm not going to trust you with just simply saying, take over the mortgage, and I'm going to have to trust you to make the payment. That's not going to work for me. And then I said, okay, well, I've got another plan. How about this? How about if we leave you in full control of it? And that converts over to what is called seller financing. So now he becomes the lender. We give him a payment. The loan that's on the property still remains on there. That's called a wraparound mortgage or an all-inclusive deed of trust. is where I'm heading, where we ended up at. So seller financing, he's going to let me borrow $35,000. Now we got to talk about a payment that makes sense for him, a payment that makes sense for the underlying loan, and a payment that makes sense for us owning the property and making it a profitable transaction. How I approached that is figured out, okay, what's it costing you? It was only costing him $153 a month to make the payment on his existing loan. So I just used that. I used the easiest thing. I said, okay, so why don't you let me borrow $35,000? I will make you a payment of $153 a month that will go towards the balance of that $35,000. You'll take that $153, send it to your lender. That will cover your payment on it. And we will work on that until we pay you off.
Well, so just a straight 153, no interest? So
that's by default my offer. That is how you do that by default.
A complete straight, the entire payment goes to principal.
On my loan, that is correct. On the seller financing loan, the wraparound mortgage or all-inclusive deed of trust, which is referred to, that was my offer. By default, by simply not mentioning an interest, it defaults to there is no interest, and yes, that is called a straight mortgage.
So, but he has interest on the 153, correct?
Yes, he does.
So basically, he put himself in a negative loan situation, even more so. So if I'm understanding the math, he's actually selling the property to us less because he's having to feed the bank more than we're feeding him.
That is correct.
And did he understand that our negotiation was a zero interest seller wrap? Did he get it? Did we disclose? Did we make sure he was aware? Did we make sure that we weren't keeping anything from him?
That is absolutely important, Michael. That's a great question. And that is very, very important in every transaction, in every negotiation that we enter with a seller. It is very important that we are both on the same page, that we both fully understand. The answer to your question is yes. And you discover that by continuing with the conversation, and actually he's the one that brought it up. He says, wait a second here, if you give me $153 a month and it goes towards reducing your balance, and if I send that amount of money towards my loan, well, some of that is going to be to pay interest. That means that my loan is not going to be reduced by the same amount. So bottom line, this is him telling me, bottom line is I'm going to have to send in $153 worth of principal, and on top of that, I'm going to have to figure out how much interest I'm going to have to also send in addition to your payment in order to maintain the balance of my mortgage to be equal to the balance reduction on yours. Is this what you're proposing? And my answer was, yes, it is. So we went further and figured out, okay, what's it going to cost you? So we continued on the process and we figured out how much interest is this going to cost you on an annual basis. So we calculated it out. Okay, the interest portion of my loan is going to be, we figured whatever it was, $1,800, whatever it was. So it's going to cost me an additional amount of let's just call it $1,800 every year that I have to pay in on interest in order to keep my mortgage down to the level that you reduce yours. Is this correct? My answer was, yes, it is. He says, well, I suppose that's not too much money to pay in. In the middle of all that, you have to keep bringing up the benefits, okay? The benefits that we as investors provide our sellers. We have to keep bringing that up. Remember, so I would say, remember, we are paying for all the closing costs. Remember, we're going to have to be the ones that pay for the repair costs. Remember, we are going to pay for all the closing costs. And also, do not forget the fact that, Mr. Seller, you did an excellent job of negotiating the price from my $25,000 to your $35,000. You brought me upwards by $10,000. So if you take $10,000 that you negotiated, Mr. Seller, and figure out what your cost of $1,800 a year, that's nothing. You did an excellent job at negotiating your price. And that makes sense to them.
Thanks for listening to Buy, Sell, Fix, Flip. We'll be right back. Are you running out of leads? It's time you tried Yellow Letters at yellowletters.com. Get motivated seller leads through yellow letters, postcards, zip letters, typed professional letters, greeting cards, door hangers, and business cards. Yellow Letters is a full-service marketing company created with your success in mind. Get the personal attention you need to get your direct mail campaign started and get in touch at yellowletters.com.
And we are back in 3, 2, 1.
Now, I saw the contract, so I know he said yes. And what did you and Ryan determine the actual value to be?
We figured $45,000.
So we're buying a house. That's a skinny deal, people. Man, it's a skinny deal. Or is it, Gabriel? So you're buying a house for $45,000, no money down, no interest, $153 a month in principal in principal payment only. What the heck how are you going to make, $10,000 is hard to get out of bed for. How are you going to make any money on this deal?
Well, our plan is to go ahead and keep this house long term. That's the time value of the money. Which, by the way, I'd like to point something out. This is exactly why it makes sense to the seller as well. Okay? Right now, he is feeding this alligator on a monthly basis, whether he sells the house to us or not. So he figures it's costing him that amount of money anyways. He's owned this property for many years. I think it's upwards of around 10 years. He's rented the property. He doesn't like it. He doesn't want to do it again. He does not want to have a rental property. And so if he's already made up his mind that he's not going to rent it again, his only choice is he's going to be feeding this property $153 a month, whether he sells the house to us or not. So we are actually providing the seller with the opportunity to do away with a property he does not want, and he definitely does not want to deal with tenants. Okay? Very, very important. So if he has to pay that anyways, there's nothing wrong with it. Your question, how are we going to make money? Well, here's our plan for it. We intend to do what he doesn't want to do, which is to keep the property as an investment, as a rental property. He's owned it 10 years, so he knows, what this property can do. The property has been rented for several years, currently vacant, and that's what opened up the opportunity, the fact that it became vacant. But the house is proven to rent for $550 a month. That means if we have $150 going out and $550 coming in, there's some money difference.
So
and
let me stop you here so everybody understands this. The pain of owning this house was so significant that he was unwilling to make $400 a month by re-renting the house out.
That is.
He hated this house so much that he was willing to not make $400 a month. That's crazy.
That is correct.
So how are we going to make
money?
It's
not necessarily the house. It's not necessarily the house, but the process, the labor, the work. of having to deal with the tenants. And again, this is why it's so great. You know, a lot of people are concerned out there about, taking advantage of folks or is this fair? It's absolutely fair. There's something that they want, and we are providing them with a solution. They don't want to deal with tenants, and we will, and we are solving that for them. This is what we do. We solve the painful situations that they're in. That's what we give in exchange for the opportunity to ask for a profit. Very important, and that's what should make us feel like we are doing a great service to the public. We are. I'm fully convinced of that. So, 150 going out, 550 coming in. That's what we're looking at. That is the picture of this transaction. Okay, we've disclosed everything. You continue to work on your advantages. You continue to work on the benefits to the seller. One of the benefits to the seller is the fact that he's paying interest. And guess what? He's going to be able to file his taxes every year and deduct that interest from his income tax return. Now, I realize that many of us are thinking about it, well, that doesn't make a whole lot of sense, but you don't know what the other person has a need for. Perhaps he has a need for deductions. There you have it. We gave it to him. The other thing that it is going to affect him is the fact that he's earning income, because the payment that we are giving him is considered income. So he will have to, when he does his taxes, file that as earned income, and that's also all covered. Again, folks, we have to be able to be clean, straightforward, let everybody know what's going to happen, because the last thing we want to do is enter into a marriage of many years and be unhappy with the other person. It all needs to be disclosed and agreed upon.
Okay, I'm satisfied we did all that. I'm shocked at what we got accomplished, but now you set a game plan on how we're going to turn this house into more money. Because right now I see $10,000. Sure. I see $10,000 in equity, and I see $400 a month and a no interest loan. But you have a plan to make more money. Tell us about that plan.
Sure. In this scenario, my favorite way of doing it is doing a lease option to my buyer. Okay? Multiple reasons why. Number one, just like the seller, I don't like dealing with tenants either. And a lease option will solve for that. Basically, we're going into a contract with our buyer saying, I don't want to hear from you. I don't care if there's repairs. It's going to be your house. Our agreement is going to say that you will be taking care of and maintaining this property under a lease option purchase contract. Now, we do have a little bit of money going out. You got to remember, we've got to buy this house, and part of the benefits that we offer to sellers that we're going to pay as a closing costs. So in the area that we're buying this property, we figure it's going to cost us about $500 to pay the closing attorney. And we do have some repairs to be done. I got to fix that window and a couple little things, $500 to $1,000. So we're going to be in this house by about $1,000 to $1,500 in order to make it to where I can actually find myself a tenant buyer. That tenant buyer is going to have the right to own this property. Okay, and because of the fact that we're offering terms, we are now able to put a market value on this property that can be justifiably more than what other properties sold for. So we will be finding somebody that we're going to put in this house for $50,000 with absolutely the most flexible terms there could be on a lease option program. When we put somebody in there on a lease option program, we collect what is called the lease option consideration. We all have a business plan. We all have a business model. Ours is we will accept no less than 5%. So 5% of $50,000 is the least we will take from a lease option candidate. Most likely will succeed at 10%, but let's always work off of worst case scenarios. The numbers show that we're going to collect $2,500 as an option consideration for our lease option tenant. that will pay for our cost to begin with, which was that $1,000 or $1,500 that we're going to spend, and commence a profitable transaction for us from the get-go.
Okay, so now I have $10,000 in equity. I have an extra $1,000 from my option consideration. I have another $2,500, if I'm understanding the numbers correctly, in value that when the option is, when they pay for the house, then I'll have another $2,500 coming to me at that point. So I've turned the $10,000 into $11,000 into $13,500. What am I charging the tenant buyer interest rate, or am I doing anything there, or are we just what's going on there?
There is the opportunity to do just that, Michael. At the stage of having a lease option, interest is not part of the plan. It's simply they're renting it. They're renting it for an amount, okay? Another area that could be explored is the fact that you can actually charge a higher rent amount. But let's assume that we just go with $550. That will be rent. They are paying rent during the time that they're in the house until they actually get it purchased. When they go to a bank, get a loan, and pay us out. At that time, they will own us, as you mentioned, $47,500 because 100% of their option consideration, we do credit it towards the purchase price. So they owe us $47,500 until they bring in a new loan to pay us out.
Okay, so how long of a term do you put on the lease option?
It is as long as they want it. Usually, it'll be somewhere between 1 year to 3 years, okay?
Uh-huh.
That's where we shoot for. So 1 to 3 years is where they...
Let's assume for a second, I'm sorry to cut you off. Let's assume for a second 2 years, that number right between that 1 and that 3. Now, I know we have a little bit of interest and taxes on, I mean, not interest and taxes, but insurance and taxes on this property. What's that? What do we calculate that monthly cost to be?
$150 interest, excuse me, not interest, taxes and insurance, I believe is what you meant.
Right, taxes and insurance. What is our monthly cost of that?
About $150.
So I have $153 going to the seller. I have $150 going to Geico and the county. Not necessarily Geico. But I have $303 going out as expenses. I've got a tenant that's going to cover all my costs of repairs, and he's going to give me $550. So if I subtract $300, I'm going to do $300 because that's round numbers. It's easy to subtract. So I have a net of $250, and I can multiply that by 24 months. So I know that's $6,000. So I'm going to add my $6,000 to my $13,500, and I'm at $19,500. And here's the special part, guys and gals listening. I'm not putting any money at risk. I'm making $19,500, and I don't have risk. Gabriel, you did a fantastic job. How many more of these do you want to do?
I want to do as many as we can find. Michael, you are also forgetting one other piece of the money making.
Uh-oh.
And that is...
Share with me.
Yeah.
Share with me.
Now, you subtracted the payment of $150 from our profits. But the truth of it is that 100% of that $150 is going towards reducing the balance of our seller carryback note, which means when we cash out, the balance of our loan will be reduced by that same amount, which means it's going to be calculated either as a profit or you can't calculate it as an expense.
So I have another $3,600 I could add to my $19,500. So wait a second. Wait a second. Wait for the number, everybody. I've got over $23,000 in this deal, and I'm not doing anything without any risk. And
That's the number.
And I got a seller who's feeding the deal. I got a seller who did a wrap with zero interest. It's just amazing to me. It's absolutely amazing to me. I don't know what to say. Can you add anything that just makes it more amazing?
There are a couple more things that are potential profit centers.
Okay.
Well, one of the other things that we can do is we can motivate our tenant buyer to convert into a owner where we actually become their lender.
Wait a second. So you're saying we can take this wrapped loan from the seller and wrap it ourselves?
That's correct.
And we can charge an interest rate on all of the money, not just a little of the money?
That is correct. We would then charge. Do you want me to say what I normally charge?
Go ahead. Share with us.
9.99. 9.99% is the rate that I charge on my seller carryback notes to my buyer. At that point, they become actually buyers. So I would take the $47,500 balance that they owe me at the end of 2 years, convert it into a purchase agreement, and they would now be taking a loan from us for $47,500 at 9.9%. At that time, they will be responsible for paying the taxes and the insurance, and we would be getting a monthly payment on the $47,500 with the 9.9% interest coming into us. And as we've already discovered, that time is the value to us. So the longer we do that for, the more our mortgage, our underlying mortgage is going to be reduced by, creating a profit there. And of course, I'd love to lend money at 9.9% all the time.
Wait a second. So I'm gonna call that almost 10% because 9.99 is almost 10%, and I've got $47,000, $47,500. If I do really quick math in my head, I'm thinking that's like $4,700, $4,750 first year, minus a little bit of principal reduction. So although we can't do balloon payments anymore when we're owner occupied, but let's assume for a second the seller lived there for 5 years and sold it and, went on their way and paid me off and all that. I'm going to be making probably as much as I'm making already in interest. Am I wrong in that calculation? Because if I take $4,700 times 5 years, and I know it's not going to be linear, I know it's not going to be $4,700 each year, but let's say it's $4,700, 45 1 year and 4,000 1 year and 3,500. I'm going to be making a buckload of money. Is that right? About
$4,000. Even if you just call it $4,000 a year and you did that for 5 years, that's going to be about $20,000 worth of interest that you will collect over the next 5 years. And by the way, the most common thing that happens, Michael, is that they don't sell it. The most common thing is that they're going to go to a bank and they're going to refinance it. And we want them to. We're not out there to take advantage of people. We want them to go out. We want that equity that we have in there versus waiting it out. We could just go and do it again. It's okay if they go and they refinance us. We want them to. So the most common thing is they'll go and refinance the loan to a better rate for them, and congratulations to them, they should.
So we're $23,100 is what we had earlier. Now at the end of 5 years, if they refinance it, now we can't require them to because there's no longer any balloons. But if they pay me for 30 years down the road, I know what I'm going to make in 30 years at 10%, or not 10%, 9.99. But at 5 years, if you say another 20, that means I've just pushed this no-risk deal to $43,000 in profit. Am I missing anything else?
Well, you are, because you still have to calculate that our mortgage is going down and down and down and down by that $150 a month for the next 5 years as well, which we haven't calculated it in there.
So I got 5 years at $1,800 a month, and I know that's $9,000. So I'm going to add another $9,000. So now I'm up to, wait for this, it's $52,000. And we didn't have any exposure. We didn't have any risk. We had a seller who was so distraught, didn't like his property, didn't want his property. He was already feeding it. We created a solution for him. He willfully accepted the solution. We disclosed everything. We disclosed more than all the other investors that I know would disclose. We did it ethically, we did it morally, we did it legally. And this is the kind of transaction that can be done when a seller calls you and says, I owe more on my house than it's worth. Congratulations, Gabriel. Thank you for sharing this exciting, real opportunity with us today.
You're welcome.
Let's go do
it.
Let's go do 2 or 3 more, okay? Or 5 more, or 10 more, or 20 more, or 200 more. Remember, our number this year, guys, is we're going to do 200 deals this year. And it's going to be a crazy year, but we'll keep you informed and posted as we go. But I just wanted to share this deal that we did yesterday. And until next time, everybody, thank you. Bye-bye.
Thanks for listening to the Michael Quarles Real Estate Show. Get more info and stay in touch at michaelquarles.com.